Now that we know the basics of cash flow statements as well as the three classifications into which the cash flows are classified, now in this video, let us see how certain peculiar items are treated in the cash flow statements. Certain peculiar items have a distinct mode of treatment in the cash flow statement. We will be discussing certain peculiar items like extraordinary items, interest and dividend, taxes on incomes and gains, and non cash transactions, and see how these are categorized in the cash flow statements. In this, first let us discuss the meaning and treatment of the first peculiar item, that is, extraordinary items. Extraordinary items are those transactions that do not occur on a regular basis. These are non recurring in nature. These transactions have to be classified and disclosed separately as arising from either operating or investing or financing activities. These items are so classified so as to enable the users of the financial statements to understand the nature of the extraordinary item and to know the effect of these transactions on the present and future cash flows of the business enterprise. So, out of the four peculiar items, we now know the treatment of extraordinary items. Now, let us discuss the treatment of the next peculiar item, that is interest and dividend. The treatment of interest and dividend is different in case of a financial enterprise vis-a-vis that of a non-financial enterprise. In case of a financial enterprise, the main business itself is lending and borrowing. In such a case, the interest paid, interest received, and dividend received is classified as operating activity. The dividends paid are classified as financing activity. In case of a non financial enterprise, however, the interest paid and dividend paid are classified as financing activity, whereas the interest received and the dividend received are classified as investing activity. Now we know the treatment of extraordinary items and interest and dividend. Now let us discuss the treatment of the next peculiar item, that is taxes on incomes and gains. Taxes may either be taxes on normal profits or on capital profits or dividend tax. The taxes on operating profit is income tax and is classified under operating activity. The dividend taxes are classified under financing activity and the capital gains taxes are classified under investing activity. Now we know how to treat extraordinary items, interest and dividends, and taxes on incomes and gains. Now, let us discuss the meaning and treatment of the final peculiar item, that is, non cash transactions. Transactions that do not involve movement of cash or cash equivalents either into the business enterprise or out of the business enterprise are termed as non cash transactions. Where investing and financing transactions do not involve cash and cash equivalents, then such transactions have to be excluded from the cash flow statements, since only those transactions find a place in the cash flow statements wherein inflow or outflow of cash or cash equivalents takes place. As such, if an asset or liability is traded in lieu of another asset or liability and there is no actual movement of cash, then such non cash transactions are excluded from the cash flow statements. With this, we come to the end of this video wherein we have discussed these four peculiar items and their treatment in the cash flow statement. In the next video, we will discuss the preparation of cash flow statements.